let's assume that you have decided to fund a company that's come before you, and you're negotiating the term sheet. Now, what is important to you in the term sheet probably changes from person to person, also changes from time to time. Back in the dot-com meltdown days, it was liquidation preference. Today, what is, and I'm not asking you to give away any house secrets here in case you end up negotiating with any of these guys, but what is the one thing that is most important to you these days in negotiating term sheets with entrepreneurs? And John, can we start with you?
Well, in the angel investment world, the real risk from our viewpoint is that the money goes into the company and then there's radio silence for 5 years, and believe me, that's not uncommon. So we look for some form of, and this is the scary word for the entrepreneur, some form of control on things that happen. So we'll have some of the negative covenants that you'll see in venture capital type Series A, and I should have maybe prefaced it by saying Robinhood's model is really to try to look like a venture capital fund without being a venture capital fund. So, so we'll look for those sorts of things. We always ask for either a board position or observer rights. We hope that the person that we have in mind actually will help contribute to your business and not simply just be a nudge. But and that's all centered on the negative covenants and the board position and other things. They're really centered on control and information. That's really where our interests are. Obviously, valuation and those and how much you're going to take and all that. But if I had to highlight one thing, it would be this control issue.
At New Light, although some of it is our partners' money, most of it that we invest is other people's money. And although we like technology and we like helping companies, ultimately we're looking for return on investment. And so to us, generally the most important criteria is the valuation, but also very important is the way the deal is structured. It has to be structured as a win-win. There is generally an element, we don't want control, but we certainly need influence, and we certainly need some legal protections. But ultimately, the thing we'll look at first is, as I said, is the valuation, since we are in business to make money for our investors.
Okay, piling on the win-win angle with one specific example of what I don't want to see in order to allow you to have a win-win. The one term that you see, it just won't go away, I wish somebody put a stake in it, is convertible deferred with a discount to the next round. And what that does is it takes the money that's then come into the company and says, all right, this money is actually hoping that the company doesn't do too well too quickly. And how much are those people really going to support you and go all out to make that moment in time the moment in time when you excel? So, be really careful about using that particular structure, because I think it is very problematic in terms of creating a win-win. For those of you who haven't seen it before or haven't gotten involved in what it details, it basically says we won't set the price of the company yet. We'll let the next round come in and set the price, but we'll place money in at a discount to what the next round will pay.